All right, let's continue on now with our fixed income material here dealing with valuation concepts. This is the first of the big readings that I see when I look at the fixed income material. We're going to deal with term structure and volatility of interest rates. And if you are not used to the dealing with fixed income securities, this may be where things thicken up a little for you. So we're going to spend a considerable amount of time talking about the term structure, why the term structure is what it is, and how we deal with changing term structure. And then at the end, we'll talk a little bit about interest rate volatility. But the term structure idea and dealing with the changing term structure is the main focus of this topic summary. So again, term structure here is a big deal. What is term structure? Well, we're going to use term structure to refer to how interest rates or yields change as time to maturity changes for a group of bonds. So what we're saying here is if we look at short-term bonds, well, what we see are low interest rates normally, and if we look at long-term bonds, then what we see are higher interest rates, right? So we would call this an upward sloping or a normal yield curve. And you see that relationship impounded into lots of things in common practice. So if you want to buy a house, you can finance it for 15 years and you get a rate of 5%. If you want to finance it for 30 years, you pay 6% or something like that. The longer the maturity of the contract, the longer the maturity of the loan, the higher the interest rate. And that makes sense if you think of it from a liquidity point of view. Longer term securities, if you are buying a bond that's longer term, has more interest rate risk. If it may have other risk too, but it certainly has more interest rate risk, then you want to be compensated for that risk and you're going to demand a higher return. Same thing would happen in any lending relationship. And if that was all we ever saw, that was we only saw upward sloping yield curves, we would just offer that as an explanation. We would call that a liquidity argument and we would be done. We could essentially move on to how to deal with changes in the slope of the yield curve. But the problem is that we on occasion see flat yield curves, that is where short-term and long-term rates are the same, and occasionally even see a downward sloping yield curve, also called an inverted curve, and that is where we see that long-term bonds have lower yields than short-term bonds. Now, this is something that is fairly rare, although I'm far enough into my career, 20 plus years now, makes me feel old to say that, but nonetheless, I'm far enough into my career that I have seen several inverted yield curves in my time where we had short-term bonds trading at 4% and long-term bonds trading at 3.5%. Well, given the liquidity argument, why would we see that? Well, the challenge that we're going to face early on in this reading, we'll talk a little bit about changing yield curves, but then we're going to come back to term structure theory, and the point that we need to make there is that we're going to try to explain why we normally see an upward sloping yield curve. That's, probably 90% of the time, but on occasion may see a flat or an inverted curve. What is inducing those effects? That is what we mean when we talk about the term structure of interest rates. Once we understand that and we talk about how the term structure changes, then we're going to talk about how to measure the risk of a portfolio to a changing term structure. We've already talked about changing interest rates at level 1 in terms of duration. We'll refresh your memory on that really quickly. But what happens when we have the term structure changing in weird ways? That's what we're going to deal with here. And then near the end of the reading, we will follow up with some volatility stuff, and that'll take us through the end of this topic summary. Well, let's talk about yield curve changes to start out with. So here what we see is a parallel yield curve change or a parallel shift. And while this is represented here as straight lines, there's no indication that the yield curve needs to be flat or represented by a straight line. But the point is we start with the original curve, and then after the change, the yield curve has the same slope. So that is short, medium, and long-term rates all changed by the same amount. That's what we call a parallel shift. And if that's all we ever observed, then a big chunk of this reading would be unnecessary because we already know how to deal with interest rate risk for a parallel change in interest rates. Specifically, at level 1, we talked about the concept of duration. And duration is the interest rate sensitivity of a portfolio to a parallel change in interest rates. And like I said, if that's all we ever saw, we'd be done. The problem with that is that's not the only kind of interest rate change we see. In fact, when interest rates change, there may be a parallel component to it, but there's likely to be other components as well. For instance, we can have what is known as a twist. So this would be a type of non-parallel yield curve change. And there's two kinds. We can have a flattening twist. Okay, so we can see that we had the original curve up here and then the new curve down here, and you can see that short-term rates fell by more than long-term rates. Okay, so this is actually a steepening curve here. I'm sorry, I stated that wrong. Okay, a flattening curve here. Here's the original curve. Okay, and the twist results in the spread between long and term rates being smaller. So we can see that we could have interest rates generally increase, but maybe short-term rates could increase by more than long-term rates, so we would have a parallel change with a twisting impact embedded in there somewhere. So we could have a parallel change. We could describe one component of the change as being parallel, and then we could add to that the idea of a twist. So parallel and twist, there's one other type of change that we need to worry about, and that's called a butterfly shift, and that has to do with the curvature or the humpness of the yield curve. So here we see a positive butterfly shift, and that's where the curve is less humped after the change. So here's the original curve. You can see that it's got lots of curvature to it, and then after the change there is less curvature. Well, that's a positive butterfly. We could also have a negative butterfly. Here you see a curve with relatively low curvature, and after the change, of course, we end up with lots of curvature. Well, that is a butterfly shift. In that case, a negative butterfly shift. The curve has become more humped, or the curvature has increased. Now, the thing you have to keep in mind here is that while we've talked about each of these three as separate effects, they're probably all going on at the same time. Generally, interest rates are increasing, okay, but long-term rates are increasing by more than short-term rates, but there's some sort of nonlinearity in that effect that would be described as a butterfly shift. So we have all three of these things going on at the same time in a typical interest rate change. Now, what about how these different types of changes impact the value of a fixed income portfolio? Well, here's a little bit of empirical evidence for you. And what we see three factors at play. So what we're talking about is the change or the variation in total return for fixed income portfolios. This data happened to be compiled from institutional data, that is institutional portfolios. But rate changes, that is a parallel change in interest rates, or the parallel change or parallel component, okay, accounted for 90% of the variation in return on these institutional portfolios. Okay, well, that's good news for the concept of duration that we talked about at level 1. Why? Because if you understand duration, that is the sensitivity of the portfolio to a parallel change in interest rates, then you're capturing 90% of the variation that's caused by rate changes. Okay, well, that's good, but remember, fixed income portfolio managers are very fastidious. Understanding 90% of the variation in total return is not enough. So what about slope changes? That is the twist that we referred to earlier. Well, that accounts for about 8.5% of the variability, and curvature changes account for about 1.5%. Okay, what we need to remember there is that these are both nonlinear, okay, or non-parallel components, and they are not adequately captured, or the impact of slope changes and curvature changes are not impacted by duration. We're going to need to introduce a new metric, which we're going to call here key rate duration. So if you take key rate duration, that is going to be a new tool that we're introducing at level 2 that is going to help us understand the sensitivity of the portfolio to changes, to non-parallel changes in interest rates. Okay, so this key rate thing, I think a lot of people worry about that more than they need to when they're preparing for the exam. I'll try to convey to you why I think that occurs, and we'll talk in depth and do a couple of examples on key rate duration as we work through this reading. So, but before we get there, we got to go back and review a level 1 topic. And so in level 1, we talked about bootstrapping. So the idea of bootstrapping was we could look at a yield curve, and let me draw you a quick picture. Okay, we could look at a yield curve, and so this is time against yield. So we'd have yield up here, and yield here, and time here. Well, if we looked at a 1 and a 2-year instrument. So I'm going to change tools. So here's our 1-year security, and here's our 2-year security. Well, those would have different yields to maturity, right? So that all makes sense. So this is an upward sloping yield curve. The one year bond has a yield of 2%, say, and the 2-year bond has a yield of 3%, just to keep the numbers whole and simple. So what does this mean? Well, if you're talking about this 1-year security, suppose this is a 1-year treasury bill, which means there's only one cash flow. Well, in that case, the yield to maturity and the spot rate are the same. Now, what is a spot rate? Remember, a spot rate is a rate we use to discount a single cash flow in the future back to today. All right, so if we look at this 2-year T note, well, when do the cash flows occur into that? Well, in the real world, of course, they come every 6 months, but let's assume it's an annual pay. Well, what that means is that you're going to get a cash flow at time 1, so you'll get a cash flow here and a cash flow here on this 2-year security. That begs the question of why we have cash flows coming at the same time from the same issuer that we're discounting at different rates. For the 2-year security, we're discounting this interest payment that comes at year 1 at 3%. For the Treasury bill, we're discounting the cash flow that comes at time 1 at 2%. Why would we discount the same cash flow from the same issuer, the cash flow that comes at the same time from the same issuer at different discount rates? So the idea behind a spot rate, and we'll see a simplified example of this in a little while, okay, but the idea behind a spot rate is we know that this 1-year spot rate is equal to 2%. So if we take the cash flow that comes at time 1 from the 2-year bond, we discount it at this spot rate, then we can solve for the 2-year spot rate. So what we would get from a spot rate curve, if this was the yield to maturity curve, as we see here, then the spot rate curve would lie above that, and we would see spot rates coming out along this line. Now, spot rates and bootstrapping spot rates, that was something you really hated at level 1. I don't think you're going to be doing a lot of bootstrapping calculations on the level 2 exam. But it is imperative that you understand what a spot rate is, and that is that it is a rate that you use to discount a single cash flow at some point in the future back to today. And the reason it's called bootstrapping is because if you know the 1-year spot rate, then you can find the 2. If you know the 1 and 2, then you can find the 3. If you know the 1, 2, and 3, you can find the 4. That's called a bootstrap process, all right? So, a real quick review here in terms of interest rate lingo. Remember, a yield to maturity, that's just it's a really complex average over time that we would discount all the cash flows at that yield. Okay? A spot rate is a rate that we're going to use to discount a rate in the future back to today, and a forward rate is a short-term rate that is expected to exist in the future. So what we do is we take the Treasury bond yields, okay, then we go through this bootstrapping process, and what we come out with is this theoretical spot rate curve for Treasuries, so that if we're given the Treasury yield, we can bootstrap out the spot rates. That is the rates that we should use to discount an individual cash flow from some point in the future back to today. Now the question is, if you're going to do that, what universe of Treasury securities are you going to use? Well, there's several options. We could use all the on-the-run Treasuries. These are the ones with the most accurate pricing. The problem is there's lots of maturity gaps here. So we have some stuff going on under a year and under, and then we have maybe a 2 and a 5 and a 10 and a 30 or something like that. But getting spot rates out over 30 years, when you go from 10 to 30 years, means that you're going to have to do a lot of interpolation, and that's going to be a big problem. So it's accurate pricing, but you have these big maturity gaps. So what we could do is we could take the on-the-run securities and then fill in with some other securities. This is going to reduce the maturity gaps, but it's also going to leave us with some missing information. That's going to be problematic. So what we could do to cure that, so we filled in some of the maturity gaps, we could fill in all of them by looking at all available Treasury securities. Well, this contains all the information. The problem is that some maturities will have several yields. So you could have a 10-year security that was issued today that has one yield, and you could have a 20-year security that was issued 10 years ago, so that's also a 10-year security today, that would have a different yield because it has different coupons and those types of things. So how are you going to deal with that? There are some methodologies out there to do that. I can promise you that you would be happy to say that's not part of the curriculum. It gets very complex very quickly. So we could use all Treasury securities, but we have this problem with the stacking these different bonds at one point in the yield curve. That's going to be problematic. We could also go back and use Treasury strips. Now we see strips at a couple of points in the curriculum. We'll talk about them later in the fixed income material. But remember, if you have a 30-year Treasury bond, and what that really represents is a series of cash flows or cash flow promises from the United States government. Well, if you have this, remember why they're called coupon bonds, right? So in the old days, okay, a bond would actually have coupons on the edge. When it was time to receive an interest payment, you'd pull off that coupon, you would mail it into the company, and they would send you back your interest payment. So it was a coupon payment. Okay, well, we don't really have that anymore, but in the computer age, but it's still advantageous to think of a Treasury bond as having these coupons. So maybe we have a 30-year Treasury, we could tear off the 15-year coupon. What does that represent? It represents an obligation of the United States government to make a payment 15 years from now, and we could sell that as an individual payment in the market. That is a 15-year zero coupon Treasury security. And that would be already in terms of a spot rate. So that would be a single security, whatever the yield, a single cash flow, whatever the yield on that is also a spot rate, so we don't have to worry about calculating spot rates. The problem with that is the market's not very deep, so we're going to get some liquidity problems. There also could be some tax distortions. So these last two slides might seem a little complex, right? So there's 4 different universes we can choose from. We can choose on the run with some supplements, all Treasury securities or Treasury strips. All of those have weaknesses. All of them have strengths. Which one are we supposed to use? We don't know. So it's not specified in the curriculum. Just realize there are different ways to calculate the term structure. All right? Okay. Swap rate curve. So the swap rate curve, well, we talked about the theoretical spot rate curve for treasuries. Well, the problem with that is, and we normally base a yield curve and a spot rate curve on treasury securities, the problem is that there's these big maturity gaps. It's also going to be, those are risk-free securities, so they have different changes in times of crisis than we would see for risky type bonds. So is there any other option out there? Well, what's becoming more and more popular is a swap rate curve. So we have swaps that are becoming increasingly preferred as the base data to create a yield curve or to create a spot rate curve, because this is not impacted by government regulation. So this is all out of the LIBOR market. Okay, it's more comparable across countries, and it's quoted at more maturities, so you don't have all those gaps in there. So we can use it the same way. The thing to realize is the swap rate curve is not a curve for riskless payments. There is that risk embedded in that because it's not the government making those payments. That is one bank making payments to another based on LIBOR is where that comes from. So the swap rate curve is an increasingly popular alternative to the theoretical spot rate curve for treasuries or to a yield curve built off of treasury securities. Now that we've done all this introductory information, let's talk about the term structure of interest rates. And if you ever lose your mind and decide you're going to go get a PhD in finance or economics, you're going to spend a lot of time talking about term structure theory. Luckily, we're going to be able to do this in 5 or 8 minutes. All right. If you get this down, I think you'll have everything you need for exam purposes. So what we're going to do is we're going to look at 3 theories. One is the pure expectations theory. The second is the liquidity theory. Actually, 1 and 2 are part of the same theory. This liquidity theory is sometimes called biased expectations. Number 1 is called pure expectations. But I think for exam purposes, if you don't want to be a theoretician, thinking of these as separate theories is probably more effective. And then finally, a slightly different approach is going to be the preferred habitat theory. And I sometimes refer to this as the anti-theory because it sort of runs counter to the other 2. So pure expectations, this is the one you want to spend most time on. That's the one that's going to take us the longest to get through. We'll get it all done in about 5 minutes, so it's not going to be a bad thing. Then we're going to move to biased expectations or liquidity theory, and then we'll spend just a couple of minutes talking about preferred habitat on the end. So what is the pure expectations theory? Well, the pure expectations theory is the idea that what drives the shape of the yield curve is purely the market's expectation about what future interest rates are going to be. So that has some very specific mathematical implications, some of which we'll be able to explore here, but we can interpret this either broadly or narrowly. The broad return says we're going to receive the same return over any investment horizon. So if we're investing if we are investing for 2 years or for 4 years, well, let me explain this one later with an example. I think it'll be easier. But basically, it doesn't matter how we slice up our horizon. The narrow interpretation is the same return over the short horizon, given whatever way we break that up. All right. So anyway, the pure expectations theory here, I think we'll get into an explanation here that will be more meaningful. So the main idea, forward rates. Remember, forward rates are short-term rates that are expected to exist in the future. So what is the 1-year rate going to be 1 year from today? That's a forward rate. Or what is the 1-year rate going to be 2 years from today? That is a forward rate. So forward rates are short-term rates that are expected to exist in the future. Okay, and the notion here is that they are solely a function of the market's expected future spot rates. So there's no interest rate uncertainty that's allowed in this particular theory. The implication that we're going to be most interested in, and this goes back to the broad implication that we were talking about on the last slide, is that long-term rates are a complex mean of future expected short-term rates. And that's going to have a very direct implication. Now, the trouble with this is that it doesn't allow for any interest rate uncertainty. So, if there's any price risk, if your horizon is less than the maturity, or reinvestment rate risk, if your horizon is greater than the maturity, neither of these play in to this pure expectations theory. So we're ignoring those, the idea of reinvestment rate risk and price risk we talked about at level 1. So we're kind of playing being very esoteric with our theory here, but nonetheless, that's all we need to get out of this. Now, the thing I want you to understand is that this implication that long-term rates are a complex mean of expected short-term rates, okay, this has direct implication for for the calculation of forward rates. So here's the point that follows from that. If we are looking at implied forward rates, suppose that we have a 2-year investment horizon. Now, how can you fill in a 2-year investment horizon? So we're going to invest today and our investment horizon is 2 years. Well, we could do that in a number of ways, but let's consider 2. One of those is we could go and we could buy a 2-year bond. Okay, so we have a 2-year investment horizon. We buy a 2-year bond that covers the full horizon. That's fine. The other way would be to buy 2 sequential 1-year bonds. That is, buy a 1-year bond, let it mature, and then buy another 1-year bond. Well, the point of the implication that we saw on the last slide is that the holding period return is not impacted by the choice of maturity. So a 1-year bond followed by another 1-year bond should, in expectation, have the same return as the 2-year bond. Let's try an example. So we have a 1-year bond that's going to return 2%, a 2-year bond that's going to return 3%. What we're going to do is calculate the implied forward rate, and what we're going to see is that that is going to be equal to 4%. Why do we know that? Well, we know that in a pure expectations environment because if we were to go out and buy the 2-year bond, that means we are going to earn 3% the first year because it's a 3% yield and 3% the second year. Now, I'm going to ignore the compounding, and that's what we're going to do in this example. Generally, we'll get a chance to pick up some of that compounding later on when we talk about forward rate agreements and those types of things. Okay, but nonetheless, what does this mean I've earned on my money? Well, 3 plus 3 is equal to 6, right? All right, so we're earning over this 2-year period, we're earning 6%. Remember, the implication is that up here, if I divide my holding period into my time horizon into 2 periods, then under pure expectations, I also have to earn 6%. So I know that in the first year, if I buy a 1-year bond, I'm going to earn 2%. So the question is, what do I have to earn in the second year? Well, 3 plus 3 is equal to 6, and 2 plus what is equal to 6? Well, obviously, that has to be 4%. So the point here is, and this ignores compounding, so actually it's going to be a little different than 4%. It's going to be 4.0 something percent. Okay, but nonetheless, the thing that you need to take away from this example is that this 4% is the implied forward rate. The 1F1, that is the 1-year forward rate 1 year from today, and we got that in a pure expectations environment. So later on, when I'm summarizing, I'm going to talk about the pure expectations math. All I mean is that you're able to calculate this implied forward rate. Here we're going to do it without without worrying about compounding. We'll see some compounding effects elsewhere in the curriculum. All right. Now, the question then becomes, how do we interpret this implied forward rate? Well, there's a couple of ways to interpret it. We can interpret it as a break-even rate. If the investor invests in the one-year bond and earns 2% in the first year, then he has to earn 4% in the second year to break even with the two-year bond. We can also interpret it as a lock-in rate. So if you invest in the two-year bond, then for the first year, because of direct comparison to the one-year bond, we know that you should be rewarded at 2% for being without your money that year. So you're effectively locking in 4% in the second year. So the two interpretations there. It is true, okay, that the expected spot rate not supported by empirical evidence, but there are some arbitrage aspects associated with this that are going to become very important when we talk about forward rate agreements and pricing of forward rate agreements and those types of things. All right. So let's sum up what we've learned about this pure expectations theory. The math of the pure expectations theory tells us that we can find the implied forward rate, but when we look at the shape of the yield curve, what does that mean about how interest rates are going to change, which is really what we're working with. What does the shape of the yield curve tell us about changes in interest rates? And you can think of the yield curve as being a pointer. So if we look at a quick yield curve, let's see, draw one on here really quickly. So this is going to be time against yield. So what do we get? Well, if we see an upward sloping curve, then think of that as a pointer. It's pointing up. That means that short-term rates are going to increase in the future. If we see a flat curve, okay, well, what is that pointing to? Well, that's pointing to the fact that interest rates are not going to change. And if on occasion we see a downward sloping yield curve, that's telling us that interest rates are expected to decrease in the future. So after all is said and done, and I realize this is a fairly simple conclusion, but the main thing you need to know about the pure expectations theory is that the yield curve is essentially pointing to the market's expectation of change. So an upward sloping yield curve, short-term rates are going up. Downward sloping yield curve, short-term rates are going down. Flat yield curve, interest rates are going to remain constant. All right? So that is the big one, pure expectations theory. We can get through the other two a little quicker. Let's talk about liquidity theory here. So liquidity theory, the main idea is that this implied forward rate that we calculated under pure expectations actually has a couple of components. One of those is the expectations that we've been talking about for the last 5 minutes, but there is also a liquidity premium that's compensating investors for interest rate risk, and it's important that you put a circle around this. Okay, it's a liquidity premium, which means the premium gets bigger as we progress to longer and longer maturities. Okay, so the implied forward rate is not just expectations, it's expectations plus a liquidity premium, and the liquidity premium is bigger for longer expectations. Well, what does that mean? Well, if we look at an upward sloping yield curve, that could mean a couple of things. It could mean that interest rates were expected to rise, but it could also mean that interest rates were expected to remain constant. How does that occur? Okay, well, let's again look at a picture real quick. So let me draw a yield curve in here. So again, this is time, and this is against yield here on the vertical axis. Well, what we can observe is the yield curve, okay, and we'll see this upward sloping yield curve. So that is, if we were in a pure expectations environment, we'd conclude, oh, this is telling us that market interest rates are going to increase. Okay, but what we're saying now is that expectations plus the liquidity premium work together to give us this observable curve. So what is unobservable might be the market's expectations about interest rates. So expectations could be here, and what is this saying? Well, if you take expectations, you see they're increasing, but the curve is increasing more because we have a big liquidity premium up here and we have a little liquidity premium down here. Well, what does that mean for us as interpreting the shape of the yield curve? Well, what that means is that we could actually have a downward sloping expectations, but just have a really big liquidity premium. The point is, what is observable in red is the sum of expectations and the liquidity premium. So if we observe this upward sloping if we observe the upward sloping yield curve, well, what that tells us is that, well, interest rates could be expected to fall, or interest rates could be expected to remain the same, or interest rates could even be expected to increase, because we know when we take those expectations, we add an unobservable liquidity premium to those expectations. So we don't know what's going on there in terms of the market's expectations for changes. Okay, now what we could do, or what we can say, is that if we observe a curve that is flat, like this, or we observe a curve that is downward sloping, then we for sure know that expectations are going down, right? So if we look at this and we say, well, we have this flat yield curve, well, we know there's some liquidity premium, so it could be small, so we could expect a small decrease in interest rates, or the liquidity premium could be large, in which case interest rates, the expectation could be downward sloping big. But if we see a flat or a downward sloping curve, we know expectations are decreasing. But if we see an upward sloping curve, we don't know if that's because interest rates are expected to fall, or because interest rates are expected to increase modestly, but there is a liquidity premium added on top of that. So the point here is, if you're looking at this, you can't observe expectations. What you can observe is the combination of expectations and the liquidity premium. All right, so let's change gears now and change to the preferred habitat. Preferred habitat says, well, okay, I like this idea of expectations plus a premium. The difference is going to be, the difference between this and the last theory is that this premium is not related to maturity. Rather, it is determined by supply and demand. So if we look at this and we say, well, we've been trying to look at the yield curve over, this full range of outcomes. So we've been trying to explain a yield curve like that. Okay, well, what this says is there are preferred habitats. So we have, some people that like to play short term, some people that like to play medium, and some people that like to play long. Okay, and each of these are individual markets where supply and demand will interact to determine the premium, and that premium can be large or small based on the supply and demand in each of these segments. So the implication here is that participants require incentive for leaving their preferred habitat. So for instance, if I like to borrow short term, or if I like to loan money short term, and it is in the medium term where there's lots of demand for borrowing, well, then in order to get me out of my preferred habitat and induce me to lend longer term, you're going to have to offer me a premium to do so. And then once you put all this together, okay, if I can get rid of some of my chicken scratch there, once we put all this together, then we can get what we see as the full yield curve. It looks like this, but the other theories try to explain it all in one piece. Okay, in this case, we're looking at it and saying, well, you tried to explain it all in one piece, but it's really in several different segments, and you'd have to look at them in a segment by segment basis to really understand them if you are an adherent of the preferred habitat theory. All right, so 3 theories for the shape of the yield curve. Pure expectations is the most important because it has the most arbitrage implications for other places in the curriculum, but you ought to understand liquidity preference and preferred habitat and be able to describe what the shape of the yield curve implies under each of those 3 theories. All right, now before we move on, let's talk about a quick review from level 1 stuff, and that is the idea of duration. So remember that duration was a weighted average time to maturity. It's also an index to price sensitivity. So if we're looking at 2 bonds, we're saying one has a duration of 8, the other has a duration of 7. Which of those has the greatest interest rate risk? Well, if we're talking about small parallel shifts in the yield curve, then the one with the higher duration is going to change more in value when interest rates change in a parallel fashion than the one with the, in percentage terms, than the one with the lower duration. So the higher the duration, the greater the interest rate risk, but duration only considers parallel changes. Most yield curve changes have non-parallel characteristics, so we're trying to gauge the interest rate risk of the bond relative to a parallel change when actually we're seeing some steepening and some butterfly action in there. So there are aspects of interest rate changes that we are not capturing with duration. The solution is to use what's called key rate duration, which is what we're going to talk about for the next 10 minutes or so. Now, remember, there's one thing that I need to remind you about from level 1, and that is your duration impact formula. So what we said was when we calculated duration would have something like a value of 8. Well, we said the impact of that, and I'm just going to put IMP, is going to be equal to -1 times duration, so I'm going to use a D there, times the change in yields, delta Y for the change in yields. So this was the amount that the yield curve shifted by, a parallel shift. This was duration. This -1, where did that come from? Remember, there's an inverse relationship between prices and yields. So if yields go up, so that is this number is positive, that means the value of the bond is going to go down. Okay, so that's why we have the -1 here. Sometimes that's just written as minus duration. So we have -1 times a duration of 8 times a yield curve change of 1%. Well, what that's going to tell us, if I can get 1% in there, is that we would expect to see a change in the value of this bond of 8%. So duration is the expected percentage change in interest rates for a 1% parallel, duration is the expected percentage change in the value of the bond for a 1% change, parallel change in interest rates. All right, so all this is level 1 stuff. So this was just a quick review. Remember this formula because we're going to see this a bunch of times as we discuss key rate duration going forward here. All right. Okay, so looking at this, what can we do from here? Well, we can talk about key rate duration. So key rate duration is the advantage here is that we're going to be able to gauge the sensitivity of our portfolio to non-parallel changes in interest rates. Okay, and I think part of the problem with people understanding key rate duration is they don't know how to say this. Is it key rate duration or is it key rate duration? Okay, and it is key rate duration. So in order to understand this, you got to put a slash here. Understand rate duration first, and then we'll explain the key later, right? So rate duration, when we talk about duration generally, effective duration on the last slide, that is a change in the value of the bond or the value of the portfolio to a parallel change in interest rates. A rate duration is a change or the sensitivity of the price of the bond to a change in a single spot rate. All right. So if again we want to look at a quick picture. So what we're saying here is if we look at this theoretical spot rate curve for treasuries, okay, that we've looked at previously. So this is going to be spot rates. So I'm going to put an S here for spot rates. Well, what we see are these rates that we would use to discount a single cash flow in the future back to today. We're going to look at this theoretical spot rate curve a bunch of times before we're done here. Well, what a rate duration is, duration would say, what if all of these things changed by the same amount? So they all went up by 40 basis points. Well, that would be duration. Rate duration says, what if we just looked at the change in the 2-year spot rate? So what if just this rate goes up? What's the sensitivity of the change in the value of the bond to a change in a single spot rate? All right, so that is rate duration, the change in the value of the bond or the change in the value of the portfolio to a change in a single spot rate. All right, that is rate duration. Let me get rid of this. Okay, so what is key rate duration then? Well, key rate duration just says let's take a bunch of rate duration numbers and pick some key spots on the yield curve. So this is typically done with either 11 or 12 key rate durations. You certainly won't see that many on the exam. You won't see more than 3 or 4. But what we're going to do is say, well, what's the sensitivity to the change in the 2-year and the 10-year and the 20-year and the 25-year or something like that? We're going to choose some key points along the maturity spectrum and then calculate the rate duration for each of those, and then we're going to put all that together. So it's key rate duration is what we're studying here, all right? Now, why is this problematic? Well, I think it's problematic because of this picture, and I think this scares lots of people, and it probably shouldn't. So what we have here is a portfolio, and this portfolio has 10% of the bond, 10% of its value is in the form of 2-year zero coupon bonds. Okay, 20% of the value is in 10-year zero coupon bonds, 40% is in 20-year zeros, and 30% is in 25-year zeros. The point is we're using zero coupon bonds here because it simplifies the example. The rate duration is going to be the weight times the rate duration for each of the key rates. So if we go and we change the 2-year spot rate, Does that impact the value of a 2-year bond? Well, spot rate is a rate that we're going to use to discount a single cash flow 2 years from now back to today. If you're looking at a 2-year zero coupon bond, it has a cash flow 2 years from today. So yeah, that's going to change. The other thing that you probably have forgotten from level 1 is that duration for a zero coupon bond is approximately equal to its maturity. So the 2-year zero coupon bond would have a duration of 2. The spot rate the rate duration with respect to the 2-year spot rate would also be 2 because that's the only cash flow for the bond. So we take 10% times 2, 10% times 0 because changing the 10-year spot rate doesn't impact the value of a 2-year zero coupon bond. Changing the 20 or the 25-year also 0, so we get the 2-year rate duration over here as the sum of the weight times the individual rate durations. Now, is that complex? Well, okay, I would say, yeah, that took some doing just to put the example together. The thing you have to remember is that this is the starting place for the typical exam question. So you have the rate durations, okay, and what you're going to do is use them to apply this methodology, key rate duration. So really, and it's a great thing to understand, okay, but you don't need to know what's going on here, okay? These are the key rate durations for each of the key rates. The key rates in this example are 2, 10, 20, and 25. Those are given to you. Here's the key rate durations, 0.2, 2, 8, and 7.5. If you add all those together, you get a relatively crude estimate of the portfolio duration, but nonetheless, that is an estimate of portfolio duration. This is the data that you're given to start with on the exam, all right? Now, so all we really have to do is say, how would we apply this? And we apply it simply by taking the key rate durations and using that duration impact formula from level 1 in a recursive manner. So it's really easy to do once you understand what data you're working with. Okay, so let's think about this in a little broader terms. So let's first think about a simple yield curve shift. That is a parallel change in the yield curve. It goes down by 50 basis points. That is, interest rates are going to fall by 50 basis points. Remember, rates go down, values are going up. So what's going to be the impact on the portfolio? Well, it's going to be -1 times the change in yield, which the change in yield is going to be -0.5. So -1 times 50 basis points is going to be equal to a positive 0.005. Times the effective duration. Remember, that was the sum. If you look back on the last slide, you add up all the key rate durations. That is a measure. It's actually a pretty crude one, but we don't need to worry about that, of key rate duration. And what we would say is that if all interest rates fell by 50 basis points, then our duration impact formula would tell us that the value of this portfolio should increase by 8.85%. Interest rates fall, the value of the portfolio goes up, and we see here that that would give us 8.85%. But that's not what we're trying to do. This is where we left off in level 1. What we want to do now is say, what if there is a non-parallel change in interest rates? How would we come up with the expected change in value? So let's look at a very funky non-parallel shift. So 2-year rates are going to be up by 50 basis points or 0.5%. 10-year rates are up by 100 basis points. 20-year up by 40, and 25-year rates are down by 80. So this is a upward shift with a positive twist and a massive negative butterfly. All right. So this is about as funky a shift as you can possibly get. If this happens, what is the expected change in the value of the portfolio specified in percentage terms? Well, all we're going to do is we're going to take this interest rate change. So that's going to be, 0.5%. And we're going to multiply that, and this is for 2-year rates, so we're going to multiply it by the 2-year We're going to multiply that by the 2-year spot rate, the 2-year rate duration, okay? And of course by -1 since it's up, so we'll probably just use the negative of the duration here, okay? And that is going to tell us the change in the value of the portfolio that is attributable to this change in this 2-year spot rate. And then we're going to do that for all 4 of our key spot rates, and then we're just going to add them together. All right, that's all we're doing here. So we're taking our duration impact formula from level 1. We're going to apply it recursively to all of these changes in the spot rates or hypothetical changes in the spot rates. So the 2-year rate, here's the -1. Here's the change in the interest rates. Here's the 2-year spot rate. That tells us that the value of the portfolio is going to fall by 0.1%. here's the 10-year rate, so -1. Here's the change in interest rates. Here's the 10-year spot rate. Excuse me, the 10-year rate duration. So there's the expected change in the value of the portfolio. We're going to do that all the way down. And what that tells us is because of this very funky interest rate change, we would expect the value of this portfolio to increase by 0.7%. All right, so that is the application of key rate duration. So if you could do duration at level 1, you know the duration impact formula, you can apply it recursively, then you can certainly handle rate duration and key rate duration on the exam. Now, let's go through and do another example just to kind of solidify this, since a lot of candidates struggle with this concept. And what we're going to do is we're going to engineer another portfolio that has some characteristics similar to the one we're working with now. That is, it's going to have the same effective duration of 17.7 years or whatever that was. 17.7, but it's going to have different sensitivities to the rate changes. And what we'll see is that there's going to be the change in the portfolio. If we have, different allocations, different weights here, then we're going to see the value of the portfolio is going to change differently with respect to a non-parallel change. So for parallel changes, if the duration is 17.7 for both portfolios, then duration will have the same predicted change. Even though it's the same predicted change for parallel, we'll see that non-parallel shifts are going to have a different impact. So here's what we're going to do. We're going to look at two shifts for a portfolio with $63.4 million in 2-year zero coupon bonds, $136.6 million in 25-year zero coupon bonds. We're going to look at a downward parallel shift of 50 basis points, just like we just did for the other portfolio. And then we're going to have this non-parallel shift, which is the same one we've looked at previously. Of course, what we're going to see is that all that's going to matter for us is going to be the 2-year rates, okay, because we have a 2-year zero coupon bond, and then the 25-year rates. The portfolio that we're coming up with here doesn't have any 10-year bonds or any 20-year zero coupon bonds, so we're not going to have anything going on there. So it's only going to be these two spot rates that are going to have. So if there's zero weight associated with 10-year zero coupon bonds, then that won't impact the equation. So anyway, so looking at this, first we'll verify what's going on with the portfolio. So the total portfolio here is going to have $200 in value. The weight on the 2-year bonds, remember there was 63 million out of 200, so that's 31.7%. 25-year bonds, 136 out of 200, that's 68.3%. Remember, the rate durations are the weight times the rate duration for the individual segment if you're dealing with zero coupon bonds. So the rate duration for the 2-year bond was 2 times its weight, 25 for the 25-year bond times its weight. So these are our new rate durations, all right? 0.634 and 17.075. What about portfolio duration? Well, remember, what we're looking at here is we're going to see that the effective duration is the same. And of course, we engineered this example to be this way. So if you add up the rate durations, what you get is an estimate of the effective duration, in this case, 17.7. So what happens if we have a parallel shift in the curve? Well, if rates fall by 0.5%, we have 17.7 effective duration. Then we see that there's a change in rates of 8.8, or change in the value of the portfolio of 8.85%. The point is, we engineered both of these portfolios that while they have different sensitivities to the individual rates, they had the same effective duration. So if we have a parallel change in rates, these portfolios, the one we described originally with 2, 10, 20, and 25-year securities, and the one we're working with now that just has 2 and 25-year securities, they're going to have the same change in value. What about for a non-parallel shift? Well, if we go and apply recursively the data for the non-parallel shift, the point of this example is that what we see here is that we get an increase in the value of the portfolio from this described change of 13.3%, whereas with the other portfolio, it was only 0.7%. The point here is that by understanding the rate durations and applying the key rate duration methodology, we were able to understand how these portfolios would change in respect to a non-parallel change in interest rates. All right? And that is the big point here. If you got through this example, you understand what's going on, then you've got a good handle on what's going on with key rate duration. So the parallel shift, the rate durations don't matter if we're talking about a parallel shift. If we're talking about parallel shifts, you go back to effective duration. when you see non-parallel shifts, when you see those two words together on the exam, that very likely means that you're going to be working with key rate durations, and you're going to say, well, here's the rate duration, and I'm going to multiply it by the change in interest rates and -1, and I'm going to do that recursively, and that's going to give me the expected change in the value of the portfolio. I do like this follow-on example here. If you can put that segment together, I think you have a good handle on what's going on with the non-parallel shifts and the application of key rate duration. So really good example embedded here in the notes. Kudos to whoever developed that. All right, so finish off. Remember what we were talking about was term structure and volatility of interest rates. So term structure was, what does the term structure look like? Volatility implies that we have changes in interest rates. So that can either be parallel or non-parallel. We're going to finish out with this idea of how do we estimate yield volatility, and what we're going to see is that there's two ways to do that. In the simple case, we can talk about historical yield volatility. That means we're going to go look, we're going to take a particular market, maybe it's the market for Treasury securities, and we're going to take interest rate observations and we're going to calculate a variance. So this is exactly the variance calculation that you saw for calculating the variance of a sample back in the third study session at level 1. All right, so this is just a variance. If you take the square root of that, you get a standard deviation. We're taking the interest rate change today less the interest rate change yesterday, so we're doing this as the change in interest rates from day to day. So the y's here are actually the yield, so the xt is the change in interest rates. So we're looking at how interest rates change from one day to the next, and we're calculating a variance. That is the historical yield volatility. I would be surprised if you actually made this calculation on the exam. But what they might want you to do is contrast the idea of historical yield volatility to the idea of implied volatility. So if you've already gone through the derivatives material, then you got to look at the Black-Scholes-Merton option pricing model. So here we're talking about taking an option pricing model, not necessarily the Black-Scholes model, because that's not a really good one for bonds or interest rates because it assumes interest rates are constant, but nonetheless, so if we take an option pricing model and we say, well, we know that when we talk about option pricing, there are 5 variables. Well, if we say that we have the price of the option and it's determined by 5 variables, and we'll go through this when we get to the option pricing. I'm not going to bust your chops over it now, but the option price determined by 5 variables, well, 4 of those are directly observable. The only one that's not is volatility. So if we have a value for the option, we have 4 things that we know, then it's only algebra to solve for the one we don't know. And the one we don't know is volatility. So when we talk about implied volatility, this is the standard deviation of yield changes that is implied by the current option price. So we're essentially taking an option pricing model like the Black-Scholes model and driving it in reverse. We're saying, well, here's the value of the option, okay, and we know the exercise price and the time and all these other things, and we're solving backwards for volatility. Now, the problem with this, of course, is we've got to make sure we're using a correct model, okay, and, the models do assume constant volatility, whereas in the interest rate market, volatility changes through time. Our next to last slide here. Sorry, thought I'd gone one slide too far. So forecasting yield volatility, okay, there is some technical reasons that I'm grateful to tell you are beyond the scope of the curriculum, that when you're forecasting, you're not calculating historical yield volatility, but rather you're forecasting yield volatility in the future, okay, then what you're going to do is you're going to assume that the yield volatility changes are 0. So this is exactly the same as what we've seen before. Instead of taking xt minus xt minus less xt minus 1 and then squaring that, we're going to take just the x sub t. And these are, of course, equally weighted observations, all that sort of stuff. So when forecasting, variance is calculated assuming the expected yield changes are actually going to be equal to 0. So that is something to remember. Again, I think that those calculations, in my world, I would estimate those to be sort of remote to actually making the calculations. All right, what did we learn? Well, this was a big reading, so this took a while to get through, and it got a little thick in the middle. We had all this theory running around about term structures, and we had to go through all the bootstrapping stuff. Then we had to deal with all that key rate duration stuff. stuff. That was kind of a bummer. And then we finished off with some stuff that wasn't too bad at the end in terms of calculating volatility. But nonetheless, by the time we got there, we were probably already tired. So what you need to do is you need to make sure that you understand what a theoretical spot rate curve is. It's important here, but it's going to be important in several other places in the curriculum. Remember, this is just, even if you don't, I don't know that the bootstrapping, how you would calculate it, is all that important, but understanding that is telling us what the interest rate would be or what the discount rate would be for a series of cash flows in the future where we wanted to discount them back to the present individually. So if we looked at that, we had this spot rate curve. We've got a rate here for 2-year securities and here for 3-year and 4-year and 5-year. These are the individual rates that we would use to evaluate individual cash flows that were 1, 2, 3, and 4 years away. And of course, in the real world, we'd have to have this stretching out 30 years in the future. So make sure you understand the theoretical spot rate curve. So term structure theory, pure expectations is the most important because you're going to see that we're going to come back to that when we do some derivatives pricing. Look, so this is easy to work with. Remember, the arm is just pointing the direction of expected change. Liquidity preference, we have two things, okay? That is expectations and the liquidity premium, neither of which is observable, but the sum of which is observable. They add together to make our yield curve. And then the preferred habitat says, well, you've got to do this in segments rather than looking over the whole thing. Pure expectations math, this implies in finding the forward rate. We're going to be able to do this in a more rigorous fashion in derivatives. Hey, but for right now, just remember that's the 4% that we calculated when we took the 2-year bond versus the 1-year bond plus a 1-year bond in the future. Okay, make sure you have that. And then you probably ought to spend some time dealing with this key rate duration. You need to get comfortable with that, and the only way that I know of to do it is to spend a fairly significant amount of time working a few examples. So if you work 3 or 4 examples on key rate duration, it's going to start getting to be very familiar to you. And what you basically have to be able to do on the exam is to deal with the key rate duration, the application of the key rate duration. Actually calculating the key rate durations is something that other than for a zero coupon bond, probably is beyond the scope of what we've discussed here today. Good luck with this material. It does get a little thick, I agree. So don't worry, work some problems. It's going to come out. It's going to work out.